Okay, I think we are live. Good morning to everyone, dear colleagues and clients. Happy New Year, first of all. I'm Antonio Argenio, Chartered Accountant and CPA. I'm even partner of ECOVIS STLX in Milan, Italy, and a member of the Supervisory Board of ECOVIS International as well. On behalf of ECOVIS International, I welcome you all to this webinar, this event that I'm proud to introduce and moderate. This is the second webinar on this ESG topics, and is following a previous webinar that was held back in April 2023 on this critical topic of ESG, environmental, social, and governance topics, and on this new European Union legislation, the so-called CSRD, Corporate Sustainability Reporting Directive. And we are here referring to a very interesting topic on which many of you are already working with, I'm sure, with assisting clients and preventing requests from clients. I'm happy to moderate today's webinar with some of our best professionals, Thilo from Düsseldorf, Germany, Hinga from Vilnius, Lithuania, and Simona from Genoa, Italy, that she's connecting. She had some problem with connection, but she will with us. I'm more than happy to realize that so many of you are joining. We are online and registered more than 85 or 86 registration up to this morning. So please remember that you can post on your probably right side question and inquiries on the comment box on the platform that we are using for running this webinar. So a few more words of introduction. As you probably know, within the ECOVIS International, one of the most recent projects refers to Vision 2030. That is a strategic project that tries to redefine the ECOVIS network strategy of the next future, with reference to the professional challenge that are striving all of us and governance of the network itself. Here, Simona is with us again. The environmental, social, and governance topics are really among the foremost interesting and challenging one in our professional and personal lives, as assisting our clients or even for private lives in this ever-changing world that is increasingly stimulating. To this end, with my colleagues, we joined the ESG group of Vision 2030, the project that is promoted by ECOVIS International, and we are working since a while on these topics, and we are very happy to introduce this webinar. This importance of these ESG topics and the upcoming change of the CSRD reporting requirements involves sometimes that ESG indicators measures a company sustainability and ethical practice in this environmental, social, and governance areas, and are becoming very important, not only for the companies, but even for investors, clients, and consumers. Basically, as you will see during this webinar, the CSRD requires that large companies and public interest entities disclose ESG information in a consistent and comparably way, including environmental, social aspect, governance, and human rights. These requirements are now addressed even to small and medium-sized enterprises. That's the reason why we are here to try to introduce these topics that are now applicable even to a very small and medium-sized company. So our expert of ESG from Germany, Italy, and Lithuania will discuss today the upcoming CSRD reporting requirements and the importance of compliance under the ESRS principle. The ESRS stands for European Sustainability Reporting Standards that have been published recently by the EFRAG, that is the European Financial Reporting Advisory Group. I'm sorry to all this very short name you will probably are already addicted on this acronym, we say in Italy. I don't remember the English words. Anyway, we hope to help you with the opportunity to prepare this upcoming change and learn how to use the CSRD reporting for business growth. Now, let's shift to the agenda of today. The first speaker will be Thilo Marenbach, who will guide us on CSRD and ESRS reporting updates and practice, with particularly reference to legislation framework on reporting obligation, reporting requirements, and overview on reporting standard set by ISSB, ESRS, and SEC, that is the US regulator for listed companies. Thilo, sorry, is a partner and director at ECOVIS Audit AG in Düsseldorf. He has over 15 years of experience in auditing and consulting of multinational clients and family businesses. In addition to financial reporting, he is also focusing on non-financial and ESG reporting. Then it will come the time for Simona Reggiani, who will guide us on materiality assessment. She will focus on the definition of double materiality, assessment process, and some example of risks, severity of impacts, and time frame. Simona is a CPA, auditor, partner with myself at ECOVIS Astilex, with almost 10 years of tax compliance and audit experience. She's a member of the ESG group at ECOVIS International, and she attended some certified courses from the ESG at SDG Academy of the United Nations. So is helping small and medium enterprises in drawing their first sustainability reports here in Italy. The last speech of today will be held by Inga Karulaitite, who will guide us on compliance and risk assessment for small and medium enterprises. She's an attorney at law, partner at ECOVIS Proventus Law in Vilnius, Lithuania, with over 20 years of legal experience. And she's leading the FinTech and Banking Finance Group at partners of ECOVIS Proventus Law. She's expert in anti-money laundering and sanctions, and is the chairwoman of the ESG group at ECOVIS International. So I now leave the floor to the first speaker, Thilo, remembering to all my colleagues that we agreed to have an assigned time for each speech of about 15 minutes in order to leave some space for a Q&A session at the end of the webinar that will last for about 1 hour. So Thilo, the floor is yours, and speak to you all later.
Yeah, thank you for the introduction, Antonio, and good morning to everyone. I will talk today about the overall legislation that leads to the increase of reporting obligations due to ESG regulation in the EU. Basically, this leads back to the European Green Deal, which was introduced by Ursula von der Leyen back in 2019. And part of the European Green Deal was the Sustainable Finance Framework that was later introduced, which has basically 3 parts: the SFDR, disclosure requirements for financial institutions, the EU taxonomy that requires businesses to report certain information on certain business parts, and the CSR directive that led to the ESRS introduced in last year. So this goes back to 2017, basically, which when the NFRD, the Non-Financial Reporting Directive, was introduced, and that required only companies that were listed on the stock exchange to report certain information on ESG topics. And from this year on, from 2024 on, the CSRD is now effective, and the ESRS are as effective, and they require businesses to report according to the ESRS. And the first companies to report according to the ESRS are those that have been required by the NFRD to report, and other companies will follow later on, which we will see on the upcoming slide. on the lower end of the slide, you can see that this legislation, this directive, has to be implemented into national law. In Germany, for example, this is done in Richtlinie Umsetzungsgesetz. So this is directive implementation law. And here in Germany, we are still waiting for the implementation of the CSRD at the moment, but this should come within short notice. So what the NFRD required is that public interest entities with more than 500 employees, listed companies, banks and insurance companies had to report certain topics on environmental protection, social responsibility in dealing with employees, human rights, anti-money laundering and bribery, and diversity in the board of directors. And this publication was required in the annual reporting or separately. So this was not a very comprehensive approach to do this because companies could choose different ways to publish their reporting. So it was not very convenient for the stakeholders to find this information in one place. And due to the fact that not a certain standard was required to do this reporting, the companies could do the reporting very differently. And that was also an issue for the stakeholders to find information that is comparable. Moreover, this was not subject to audit. So in many cases, the board of directors or the board of supervisors required an audit, but this was not mandatory. And therefore, this was also an issue that created big loopholes in the reporting. So the Corporate Sustainability Reporting Directive now requires in 2024 all companies that are in scope of the NFRD to report according to the ESRS. From 2025 on, companies that exceed 2 or 3 criteria, 250 employees, 25 million in total assets, and 50 million of sales are required to report under the CSRD using the ESRS. And from 2026 on, certain capital markets, small, medium entities that exceed 2 or 3 criteria, 10 employees, 450,000 in total asset, and now 900,000 in sales are also required to report according to the CSRD. So the big change is what will happen next year. That one from 2025 on. All large entities, which is in Germany the Mittelstand, will be required to report under the ESRS. And there are new rules for the reporting. And the new rules are that you have to use double materiality in order to define what you have to report. This is a topic that will be later covered by Simona. You have to report according to the ESRS, the European Sustainable Reporting Standard, which we will discuss later. You have to consider sector or industry-specific standards that will be later on developed. And the reporting has to cover the entire supply chain of your business. So it's not only your business itself, but it's the supply chain before and after your business that has to be covered in your reporting. And mandatory audits are now required. These can be done with limited and later with reasonable assurance. And the reporting has to be done in one place in the management reporting. And by this, the European Union wants to clarify the reporting standard and to create a unified reporting, not a non-financial and a financial reporting, but a corporate reporting that covers both financial and non-financial items and is more suitable to the stakeholder. So as already mentioned, the CSRD introduces the European Sustainability Reporting Standards, which have been prepared by the EFRAG. The EFRAG prepared 12 standards. There are 2 cross-topic standards with general requirements and general disclosures that have to be obliged or used by every entity that reports under the ESRS. And then there are 3 sections like ESG, environment, social, and governance, that cover specific topics or specific standards. So there are 5 standards for environment, climate change, pollution, water and marine resources, biodiversity and ecosystems, resource use and circular economy, 4 standards for social, own workforce, workers in the value chain, affected communities, consumers and end users, and 1 for governance, business conduct. And then there will be later on sector-specific standards, small and medium-sized enterprises or proportionate standards for those businesses, and standards for companies from third countries, because the CSRD not only requires companies within the European Union, but certain companies from other states that do business in the European Union to report under the CSRD. And for every reporting area per topic, the company has to report their governance approach, the strategy for this topic, impact, risk, and opportunity management, and metrics and targets. And all this requires a materiality analysis. As I mentioned, this will be emphasized by Simone later on, which then leads to a certain area of reporting for every company. For example, if a company does not affect water and marine resources, there is no need to report on this. Or if the company has no effect on biodiversity and ecosystems, there's no need to report on this, but to report on the other topics. Also, one requirement under the CSRD is that all companies that fall under the CSRD have to report according to the EU taxonomy regulation. And this means additional disclosure requirements. There are 6 environmental objectives under the EU taxonomy regulation: climate change mitigation, adaptation to climate change, sustainable use and protection of water and marine resources, transition to circular economy, pollution prevention and control, protection and restoration of biodiversity and ecosystems. And a company has to make an assessment of environmental sustainability of its activities. First of all, you have to consider if there is a significant contribution in your business to at least one environmental goal, sustainability contribution, one of the 6 on the left side. Then you have to consider do no significant harm criteria. So first of all, find out if you make a significant contribution to one of the 6 topics, then find out if you make do no significant harm to one of the other significant topics, and a minimum protection of occupational safety and human rights. And then you have to report the transition of the sustainability assessment into financial indicators for revenue, CapEx, and OpEx. And this is a requirement that has been done by those companies under the NFRD. So if you look at the reportings issued by big companies from the stock exchange, you can find examples for that. And now all the companies that fall under the CSRD are required to do this reporting as well. As Antonio introduced, I just want to give a short look out how this compares to other standards. And in this slide, you can see, or I picked 2 other standards: the SEC, the standard or the government board from the US, the ISSB, the International Sustainability Standard Board, which was introduced by the IASC, and the EFRAG standards, the ESRS. And the difference, or what identifies or what differentiates the ESRS from other standards is that it has an all stakeholders approach. So the focus is not only on investors, but on all stakeholders like workforce, own workforce, affected communities, and other stakeholders of the company. And standards like the SEC standard or the ISSB standards focus only on investors. So it's let's say a different scope, or a smaller scope for the SEC and the ISSB standards. And the EU implements now a standard that wants to cover the informational needs of all stakeholders of a company. one big topic is the materiality assessment. And if you compare the approach that is now introduced by the EFRAG in the ESRS, it's a double materiality approach, which we will see later on in Simona's presentation. And this is basically a perspective for all stakeholders. And the ISSB, for example, primarily pursues a perspective of investors who use information from sustainability reporting to assess the value of a company. And that's one big difference between these standards. And this will probably lead to more disclosures in reportings within the European Union than in other countries. But this is something that we will have to see in the future when the first reportings are available. And the general conception of this is that these materiality concepts are not competing, but complementary, so that the EFRAG wants to cover the information needs of more stakeholders than other standard setters. So that's all what I wanted to say, and thank you. And yeah, I give back to Antonio.
Yes, thank you, Thilo, for this presentation. We understand that this is a very, let's say, still complicated framework that we are trying to simplify and giving to you all this information. Now is the turn and the time for Simona's speech. Simona, the floor is yours. Here, ciao Simona.
Hello. So,
okay.
Welcome everyone. And my presentation will be about the materiality assessment according to CSRD and ESRS. So, first of all, the definition of materiality. The definition of materiality is included in Article 19 and 29 of the Accounting Directive, as it has been modified by the CSRD. And in particular, in this article, it is said that undertakings have to show information necessary to understand, on the one side, the undertaking's impacts on sustainability matters, but on the other side, also how sustainability matters affect the undertaking's development, performance, and position. And this information have to be included in a dedicated section at the management report. Then paragraph 29 of the CSRD further explains that the double materiality presents two perspectives. On the one side, we have the risks to the undertakings, and on the other side, we have the impacts of the undertakings. So, undertakings have to disclose information that is material from both perspectives, as well as information that is material from only one perspective. So, the double materiality concept can be represented as the mathematical union of two sets, the impact materiality set and the financial materiality set. So it is not represented only by the intersection of these two sets, but by the mathematical union of the two sets. In this case, it is represented in the red outline of this illustration. So, as regards the materiality assessment process, the European sustainability reporting standards do not mandate a specific process that entities have to follow. So this is left to the judgment of the undertaking. But in the draft implementation guidance published by EFRAG at the end of December 2023, and it is open to public feedback until the 2nd of February 2024, there is an example of the materiality assessment process composed of 4 steps. So the starting point is understanding the context. Then we have the identification of actual and potential impacts, risks, and opportunities related to sustainability matters. Then the first step, step C, is the assessment and determination of material impacts, risks, and opportunities related to sustainability matters. And then we have reporting. So Now, what I'm going to show you are some examples that are included in the draft implementation guidance published by EFRAG I mentioned before about the materiality assessment. And these examples aim to make the materiality assessment process more concrete. So the first examples are about the impacts for which risks emerge over time. So take the case of an oil and gas company, which has identified a negative material impact in the absence of agreement with indigenous people about land use for extraction, relocation, and community. So, even though at the reporting date the undertaking does not identify any risk because there are no protests, the undertaking has to take into account the fact that the community may later protest, and this may represent a risk in the medium and long term. Another example is that of an undertaking that has identified a material negative impact in the discrimination based on gender when promoting employees. So, also in this case, even though the undertaking has not identified any risk at the reporting date because there were no legal proceedings, it has to take into account the fact that in the future, female employees may sue for financial compensation, and this represents a risk in the medium and long term. But risks can also stem from dependencies and not only from impacts. An example is that of undertaking A, which is a company active in organic agriculture. So there is a low environmental impact. So apparently there are no negative impact in the environmental aspects, but there could be risks because there are some entities working locally that use pesticide, and the pesticide decrease the number of pollinators. And since the organic agriculture company depends on pollinators, the decrease in number of pollinators represents a risk to undertaking A. Another example is that undertaking B, which is a company with a factory running on renewable energy. So it has low greenhouse gas emissions. So even in this case, there are no negative impacts on the environment, but there are risks because the undertaking B is located in a coastal erosion area. So it is dependent on this specific area. And so it is subject to risks due to flooding and extreme weather conditions. A third example is that of undertaking D, which is a legal service company, and so it is dependent on human capital, even though it grants adequate working conditions. So apparently there are no negative impacts with reference to the social aspects. But if you consider the fact that another legal service company granting the same adequate working conditions offers higher salaries, this may cause staff turnover, and so a financial risk because of lower income for undertaking D. Another important aspect is the time horizon. So, take the case of a company that uses microplastics within its production processes. So, it can represent a risk, a material risk, in the short and medium term, but it is not a risk in the long term if the undertaking is investing and it is adapting its production processes in order to avoid the use of microplastic in the future. So on the contrary, if you consider environmental changes that may represent a material risk of impairment of assets in the long term, it is not a risk if the assets are fully amortized in the medium term. So another important aspect that has to be considered is the severity of impacts. So the negative impacts, actual, potential, their materiality is based on severity, and the severity is determined by the scale, so the gravity of the impact, the scope, the spread of the impact, and its irremediable character. If you consider an undertaking A, which has a material negative impact in the pollution because of its scale and irremediable character, the fact that undertaking A is acquired by Group B, which has lots of subsidiaries with other negative environmental impacts, this does not affect the severity categorization of scale and irremediable character of the negative impact which was identified by undertaking A. And the use of quantitative information is fundamental and is useful to understand the severity of negative impact. For example, the amount of water used in a particularly water-stressed area is very useful to understand the scale, so the gravity, of the impact of water consumption. Or another example is that of the number of people affected in a community where an undertaking has a factory, production site. This information can be useful to understand the scope, so the spread of the impact of pollution. A third example, or the global reports, statistics, graphs, so all this kind of quantitative information in general, they can be useful to understand severity of impacts, for example, for biodiversity loss. Another important aspect is disaggregation of information for a proper understanding of material impact, risk, and opportunities. And the disaggregation level can be different. For example, a disaggregation by significant site. So if we consider the impacts relating to water usage, the information related to vulnerability to water stress by production size. So this level of disaggregation can be very useful. So if I have an undertaking with lots of factories that are located in different geographical areas, this level of disaggregation is useful for a proper understanding of the impacts. And this level of disaggregation can be different from that can be found in the financial statement, because segments for financial reporting are often based on products and services and not, for example, on production sites. Another level of disaggregation that can be used in sustainability report is a disaggregation by country. So consider a group composed of an holding company and then lots of subsidiaries that are located in different countries. So if you look at the group as a whole, you see that there are adequate working conditions. But if you concentrate on country 3, where subsidiary D is located, and the subsidiary D employs the 15% of the group workforce, you notice that there are wages that are lower than respect to the average of the country, and there is the lack of collective bargaining, and this represents a material negative impact. So only with the disaggregation at country level, this particular negative impact has been identified. And so also the disaggregation by country can be very useful for impacts related to pollution, corruption and bribery, child labor. Why? Because context, laws and regulations and labor market practices vary from country to country. What else? So the disclosure is different and it is regarding the problem area of the material impact, risk and opportunity. What does this mean? So consider a group composed of an holding company and then subsidiary A, which is active in sector A, and subsidiary B, which is active in sector B. And only in the sector A, a negative material impact has been identified in water consumption. So according to the European Sustainability Reporting Standard E3, Water and Marine Resources, there are some kind of information that have to be disclosed for the entire group, and this is the total water consumptions in cubic meters for our operations. But there will be additional information that will be concentrating only on sector A, and so subsidiary A. Why? Because water consumption has been considered as a material negative impact only for sector A. And this information will be about the total water consumption in areas of water risk, policies, actions, and targets addressing the management of this particular impact. So another important aspect is this. So even though you have identified a material negative impact, and but at the same time you realize that you have not adopted the respective policies or implemented the respective action or set the respective targets, you shall disclose that this is the case. And you may also report a time frame in which you aim to have this in place. So, for example, if you have identified the lack of health and safety training as a material negative impact, then you have to write down in your sustainability report if you have formal training policies or actions at the reporting date. And if you do not have these formal training policies or action, you will write down this. But also, if you are working on drafting and implementing such policies and actions, for example, in the next couple of years. So this was my last slide, and so I hope that with my presentation today I have given you a preliminary understanding of some key aspects of materiality assessment under the CSRD directive. And if you have any further questions or would like to delve deeper into specific points, please feel free to reach out. And now, so over to Antonio to introduce the next presentation.
Thank you, Simona, for your speech. Very interesting. I can add, as you probably understand, this very strict use of the terms of the undertaking, that is the entity that will be subject to reporting is a particular term that is used by the standards. So the other point that I would like to underline is the very importance of this double materiality assessment, which try to work on risks and impacts of the analysis. So it's something that goes beyond figures, beyond numbers, or tax calculation that we are used to work with. So it's a new way of working in a very wide and different mode in helping clients on this aspect. So now is the time for our last speaker, Inga, that will guide us on ESG compliance and risk assessment for the small and medium entities. Thank you, Inga. The floor is yours.
Thank you, Antonio, for introduction. Hello, everyone. So today I will focus on the ESG reporting compliance and risk assessment for small, medium enterprises. For now, it is not mandatory, and the majority of the companies will still be non-mandatory for the foreseeable future. However, as my colleague Tila explained, next to the ESRS, later there will be publications focused on small and medium enterprises, and proportionate standards will be adopted. As well, in the future, both according to ESRS and voluntarily, more and more small and medium enterprises will choose to perform sustainability reporting. And in this presentation, I will shortly discuss what is the advantage of voluntarily reporting and what are the challenges and how to cope with them. So, voluntarily sustainability reporting allows small, medium enterprises to proactively manage both the positive and negative social and environmental impacts generated by the businesses. This proactive approach can help identify and mitigate risks, as well as capitalize on opportunities related to sustainability. In today's market, there is a growing trend among lenders and investors to prioritize businesses that demonstrate a commitment to sustainability. By engaging in voluntary sustainability reporting, small, medium enterprises can make their businesses more attractive to these financial stakeholders, potentially leading to better financing options and investment opportunities. Sustainability reporting often involves identifying and implementing more sustainable and consequently often more efficient ways of working. This can lead to significant cost reductions in areas such as energy use, waste management, and resource allocation. By showcasing a commitment to sustainability, small, medium enterprises can increase their long-term viability and attractiveness for future sales or succession. This is particularly important for family-owned or smaller businesses looking to pass the businesses on to the next generation. Consumer demand for sustainable practices is increasing. Voluntary sustainability reporting can enhance an SME's brand image, particularly for consumer-facing businesses by demonstrating a commitment to responsible practices. Engaging in sustainability practices and reporting on these efforts can open new market opportunities and attract a broader range of clients and customers, especially those valuing sustainability. As well, while not all small and medium enterprises are currently mandated to report on sustainability under EU or national regulations, these requirements are likely to extend to smaller businesses in the future. Voluntary reporting prepares small medium enterprises for this eventually. And large corporates, as part of their sustainability strategies and to meet their own reporting requirements, as just explained, according to ESRS, increasingly require their suppliers, including small medium enterprises, to provide sustainability data. Voluntary reporting equips small medium enterprises to meet these demands. For lenders, investors, and corporate clients who collect data from small medium enterprises to manage sustainability as part of the business decision, SMEs that already engage in voluntary sustainability reporting can provide valuable insights and data more readily. And small medium enterprises that voluntarily report on sustainability can more easily align with data aggregators or platforms that support the provision of data to corporate clients, enhancing their visibility and competitiveness. So, voluntarily sustainability reporting positions them favorably in the eyes of investors, lenders, and large corporate partners. It also prepares them for future regulatory requirements and as well enhances their overall competitiveness in the market. What are the challenges for small and medium enterprises for compliance? So, small medium enterprises play a crucial role in sustainability, but face unique challenges. Company managers usually do not know where to start on the sustainability journey in their companies and how to implement a sustainability strategy and integrate it into their business models. Small, medium enterprises face many compliance challenges, but sometimes or maybe usually lack resources and know-how on the specific area. Small, medium enterprises often face challenges in understanding and interpreting regulatory requirements around sustainability information and supply chain due diligence, because it is really complex matter. Although not all small medium enterprises are currently mandated to report on sustainability according to EU CSRD, these requirements may be extended later on to at least some of the small medium enterprises in the foreseeable future. Large companies are required to take into account how their partners take into account social and environmental criteria when preparing sustainability reports, as required by ESRS. So large companies are increasingly integrated sustainable practices into all aspects of their operation, including to their contracts with the partners. My colleague Simona already explained a lot about determining the materiality. However, for small, medium enterprises, determining the relevance and materiality of various sustainability aspects is significantly challenging. For instance, a low-risk micro business with an owner-manager and one employee may find that completing all sections of a sustainability assessment is not relevant. Assessing each item's relevance and materiality specific to business's model and sector is crucial for small, medium enterprises to ensure their compliance efforts are targeted at and effective. As well, small, medium enterprises often grapple with the question of how to start their sustainability journey and integrate it into their business models. Deciding whether to begin with policies and strategies or to explore other options can be daunting. It is essential for small, medium enterprises first understand what sustainability means for them, and then to develop strategies and policies to integrate it into their business models. We will talk about it a little bit later as well, while explaining new EFRAG drafts. So as explained in the previous slide, companies need to understand what sustainability means to them and then start developing strategies and policies that integrate sustainability into the businesses. The sustainability journey should start with data that is accessible and understandable to all. Disclose water, gas, heating consumption, start with waste segregation. Conduct a risk assessment to identify the most significant risk in the company. Prepare internal procedures in line with EU social and environmental requirements, such as company policy to manage significant impact risk and opportunities related to climate change mitigation and adaptation, a code of ethics, and other. How to prepare for voluntarily ESRS reporting. So first of all, one should understand ESRS framework, how it is constructed, what are the requirements raised for the large incorporation, what data they are gathering and reporting. Another aspect, companies must identify and engage with relevant internal and external stakeholders, including employees, customers, investors, and local communities, to understand their expectations and concerns regarding ESG issues and conduct materiality assessment. The last but not the least aspect is to develop and implement policies and practices that align with EU social and environmental requirements, according to which the companies would act. EFRAG is developing a voluntarily simple and standardized methodology to report on ESG matters, which will be known as the voluntary as small medium enterprises European Sustainability Reporting Standards, or the SME ESRS. The simplified ESRS are still under development, but to ensure proportionality, they are expected to include the following key features. First, a focus on materiality. The simplified ESRS will only require small-medium enterprises to report on sustainability matters that are material to their businesses. A simplified materiality assessment process. The simplified ESRS will provide guidance on how small-medium enterprises can conduct a simplified materiality assessment. As well, there will be reduced number of reporting topics. Just the important for these small medium enterprises, a simplified reporting format as well will be adapted. The standard aims to assist small medium enterprises in contributing to a more sustainable and inclusive economy, and the objectives of the standards, these voluntarily standards, are improvement of sustainability management, including focus on addressing environmental and social challenges such as pollution, enhancing workforce health safety, supporting competitive growth and resilience in the short, medium, and long term. Second objective is access to finance means, because providing crucial information to satisfy the data demands of lenders and credit providers will be one of the objectives of these standards. Enhancing investors' relations through transparent and sustainability reporting as well is one of the key aspects. The third objective is strengthening the supply chain relationship. This means supporting small, medium enterprises in providing necessary sustainability information to their suppliers, as well as enhancing supply chain transparency and compliance with larger enterprises' sustainability requirements. The voluntarily standards include 3 modules that the undertaking can use as the basis for preparation of its sustainability report. So there are basic model, narrative, policies, actions, and targets, PAT model, and business partners model. Once chosen, a model shall be complied with in its entirety, subject to the materiality considerations. Now I will describe in short the basic model. Here are the key features of it. So, applicability for small, medium enterprises. This model is the target approach for micro undertakings and a minimum requirement for other undertakings. Unlike other models, the basic model does not require a materiality assessment. While the basic model can be used independently, undertakings are encouraged to provide additional qualitative and quantitative information if they wish to offer more comprehensive reporting. This could include integrating metrics from the basic model with disclosures from the narrative PAT model and or business partners model. The undertaking may briefly describe specific practices for transitioning towards a more sustainable economy in case it has them in place. And reporting requirements, if the undertaking chooses to adopt this model, it must comply with it in its entirety, ensuring all applicable information is included. Applying the basic model is a prerequisite for utilizing the narrative PAT and or business partners models. And as well, EFRAG offers the guidance for the preparation for this model adaptation. Next, the narrative, policies, actions, and targets model. Its key features are the following. So there are narrative disclosures. It defines 5 narrative disclosures that small, medium enterprises should report if they have formalized and implemented already policies, actions, and targets related to sustainability. This model is suggested to undertakings that have already formal PAT. This model supplements the basic disclosures. They supplement these 11 basic disclosures, provided that undertaking has already established such practices. This model is particularly recommended for undertakings that have formalized and implementing policies, and materiality analysis is required in order to disclose which of the sustainability matters are relevant for the undertaking businesses and organization. This analysis helps to ensure that the report focuses on areas of most significant impact and interest to stakeholders. The model assists undertakings in aligning their sustainability disclosures with the business models and organizational strategy, thus creates a narrative on how sustainability is integrated to their operations. The next model is business partners model, and it has as well its own key features. So it provides additional data points related to the information generally required by business partners, investors, and lenders of undertaking. These data points are designed to address the data request that the undertakings may receive from these entities, particularly when they require sustainability data from their suppliers. The model requires the materiality analysis to determine which sustainability matters are relevant to the undertakings, businesses, and organizations. There is a list of disclosures, 11 disclosures that should be considered and reported upon if they are found to be material following the materiality analysis. If a disclosure is not reported upon, it is assumed to be not material for the undertaking. And as well, the model includes instructions to support the preparation of the disclosures from 1st to 11, ensuring that undertakings can comply with the reporting requirements accurately and efficiently. So this is all I wanted to say, and thank you very much for attention, and I hope I put some light on how and why the sustainability standards should be used by small, medium enterprises. And if you have any following further questions, so let's connect and let's keep in touch. Thank you.
Wonderful. Thank you, Inga, for your presentation. Awesome. And we understand something more on the importance of the ESG standards and the challenge even and risks that we will face on this new kind of reporting. We are all new on this reporting, so we are studying with all the profession from the network on these topics. We understand that even from small, medium enterprises, there's on a voluntary basis, a simplified model that we can apply. Thank you again. I would like to be back even on Simona's speech, saying that particularly with refer to the disaggregation, it's very important. It will be very important. The network and the ECOVIS, let's say, cooperation among different countries in which our clients will have and have subsidiaries. I cannot see questions on the chat apart from the request of registration. Yes, this webinar, as anticipated, has been recorded, and it will be available on YouTube and on our ECOVIS intranet. So we can now come to the conclusion of this webinar. Thank you again for the participation. Thank you to our speakers. I hope you enjoy this effort, and with my colleagues, we remain at your disposal for any further clarification on to help you and colleagues and clients on these topics. So I wish you a productive and busy 2024. Have a nice day. Bye.
Bye. Thank you very much.
Bye.
Bye.
Bye-bye.
Thank you, Tilo. Thank you, Inga. Thank you, Simona.